Hello investors, I'm Adam Carlini. With me is Gary Luna. Behind the camera today is Grant Haddon, and we are Dynamic Wealth Management. We're glad you joined us. This is our update on the markets for February the 18th, 2016.
Markets have been pretty good the last 3 days, actually surprisingly good. So the question is, do they continue? Does this rally stop here? We'll talk about that, talk about why the rally happened a little bit, and give you some more information on the economy.
All right, so before we get into the nitty-gritty, we'll just tell you about some upcoming events. We have, of course, every other Tuesday is our Investments for Breakfast. Our next one will be March 1st, and then after that, 2 weeks later on the 15th. Those are always at 9 a.m. in our office, in our conference room. We provide you with Danish and coffee and so forth. It's an opportunity, if you're not a client yet, to come get to know us, ask questions, get our feel on what's happening in the markets and some strategy ideas. We welcome you to come, and as well as clients. We love to have our clients come and visit as well. We also have upcoming even sooner, if you'd like to get to know us more and see what we do and how we do it. We have an investment seminar coming up on February 23rd. That will be in our offices here, Dynamic Wealth Management. And call in at the number below and you can reserve your seat. I believe that one's going to be at 5 p.m. and dinner will be provided. So give us a call. We'd love to see you. All right. So our ETF model, our core ETF model, right now is giving us a bearish indication still. You can see that we're just below the neutral zone. And Gary will talk more about that and show you just exactly where we are. But as a result, we remain bearish in that model. We have been since January 11th. You can imagine that as a result, we also are performing much better than the market, which is down year to date, even after the most recent rally. But we are getting close to that neutral zone. It could rally back up in there with this rally we've had this last week. We'll talk about that and whether or not we think it'll get there. Really, whether we think it will or not isn't the issue. If it gets there, then we'll go neutral and we'll add some more positions. But right now, we're all defensive in our core ETF model. Just I may add here also, we are all defensive also in our sector rotation model. So, looking at some key events that have happened this past week, you may have noticed the market had a pretty significant rally. What caused that? Well, one thing that may be responsible is some short covering. Short covering is when people sell a stock short, they're betting the market's going to go down. But they get a little nervous sometimes when the market hits a support level and starts to rally back up. And as the market began rallying, people began covering those short positions. That is very different than the character of a market where people are buying stocks because they want to hold them longer term. And so it would appear from this chart that we got from Bespoke that the rally we've seen at least the last couple days has much more to do with short covering. You can see the stocks that were shorted the most are the ones that rallied the most. So that is characteristic of a short covering rally. We'll see if it has legs. Why was there short covering? Well, it had a lot to do with oil. The markets have been following oil lately. Ironically, we were told last year that with lower oil prices, the market would rally because people would have more money to spend. But that has not been the case. Instead, the relationship has been a direct correlation where when oil goes up, the market seems to like it and go up, and when oil goes down, it goes down. And since oil's been going mostly down, the market's been mostly down. This last week, however, everyone got excited because OPEC was hinting that they were going to cut production and support oil prices. And so the market began to rally. However, we just found out that they're not really cutting production. They've just agreed to freeze. Well, they're talking about it anyways. Iraq and Iran, those are other stories as to whether or not they'll actually participate. That's kind of day to day. But that gave the market some hope that oil might go up, and that in turn started the market moving up, the overall stock market. And which then again, as we showed in that last slide, it appears may be more short covering than a real longer term rally. So looking at oil, you can see here we did have this hammer candle down here. When you get a hammer candle like that, it usually marks a reversal of a trend, and in fact it did. Market began to rally. It doesn't mean the trend will be a long-term trend, because you can go back and look up here. There was a hammer candle right there, and you'll notice the market had a nice little rally, which then failed and went lower. So hammer candle doesn't tell us about long-term trend, just short-term changes in the market. And right now it told us that oil possibly had bottomed. But again, you can see this long-term downtrend has not been penetrated. So we wouldn't get excited about oil just yet. Other positive news that helped the market this last week was the jobless claims, the 4-week moving average, and we want to generally look at the moving average to smooth it out. The moving average for jobless claims actually improved, and so that meant the economy is a little, maybe a little stronger. Of course, you have to question what are the quality of those jobs. Are these hamburger flippers or are they research scientists? Probably more of the former. So we'll see, as far as how much real strength we see in the economy. Many other indicators are showing that the economy is not strengthening, and the Federal Reserve even recently has also concurred and actually suggested that was the case. The economy was not as strong, and therefore they may not raise rates as aggressively or as soon or at all. So that's our position right now. Those are the things that have happened then in this last week that have affected the market. Gary will now talk about where things are at and where they may move going forward.
Want to thank Adam. I thought he did a great job with his update as far as some of the key things that are going on within the economy. Let's start giving you some more details about numbers as far as the stock market, other key markets. One of the things we were asked is if we could just give out key numbers year to date. So what you're looking at here is a chart year to date of key areas. So we have the U.S. stock market, which is down now 5.3 after the rally. International market, developed countries down about 7.6. Emerging market equities down about 5. Real estate 6.8. High yield bonds down about 4. And commodities down about 5.5 now. Notice that all the risky assets, right, are all down. So we asked the question, risk on or risk off? Well, obviously you can see that we're still in a risk off mode because notice the defensive assets. Gold has done very well year to date, very volatile asset, but it has done well. And short-term and longer-term treasuries also have done well. Now, if we take this same chart, those same assets, and we go a step further, now we're going to take those same assets from the recent high back in May 20th of last year for the S&P 500. Now you see a little bit broader picture of this downturn that began back then. Notice that U.S. stocks have held up relatively well compared to the rest of the world. In fact, emerging market stocks, coming back to that point in time, are down actually over 20%, 26%. Overall developed countries down 18, almost into bear market territory at 20. And of course you have real estate that has held up relatively well. High yield bonds down about 14%. And of course commodities driven down by oil down 30%. But again, notice the more defensive sectors, again, since that point in time have done well. And of course that's why through our ETF model, we are mostly, or actually all in these type of assets going forward until the market shows us something better. Speaking of the relatively strong U.S. market, as we look at year to date, the different indices, you'll notice that the Dow is holding its own the best, and that would be to be expected in a defensive type market. Down only 5.8, S&P down about 6. NASDAQ, though, down over 10, and the Russell down over 11. Again, if we go a step further on these U.S. indices and take it not just from the beginning of the year here, but we go back to that May 20th, which could be the high point of this down market, we see that the Russell down in bear market territory already, actually got as low as 24%. NASDAQ had been down 16, down about 11 from that point. S&P down about 10, and so is the Dow. So that paints a better picture for us of this broad downturn that we've had of late. And that's why we are skeptical of this little 3-day rally, as Adam explained. We want to see more of that before we get excited. There has been substantial damage, technically,
all across the markets in different sectors, asset classes, different countries. So a 3-day rally is just not going to do it for us. We got to see more of it. In fact, here is that 3-day rally by the S&P 500. The problem is it got right back up to a level of resistance somewhere around 1941, and you also have the 10-day moving average sloping downward, which will also be technically in a level of resistance. And of course today we did have a down day, market down about a half a point. So we would not be surprised to see this market pause here or turn back, but the market will do what it wants to do. So if it does surpass, then it'll be back in this area. The next level would be up to 2,000. But again, we are skeptical, but we will wait and let the market come to us, and obviously we will take action according to what the market dictates to us. We are reluctant to make predictions because that's where bias comes in, and we'd rather let the market show us what it's going to do and react appropriately. As you can see by our main indicator, which is our stocks to cash indicator, this is, even though it looks like the pure stock market, it is a ratio of stocks over short-term treasuries. There is the recent upturn over the last week or so, but obviously we are still below levels where we would begin to add money back into this market. And so we will hold off, and we will obviously take our signals on a weekly basis. Remember, we take them every Friday and reallocate on Monday if necessary. So for now, we remain defensive on this market. Even though it has improved, we will hold off, and we want to see more of evidence and more substantial price improvement. That is all we have for you for this update. We thank you for allowing us to spend time with you. Please let us know if you have any feedback. Remember, this is all done just to update our clients and update prospective clients on how we see the market. This is not in any way a solicitation to buy or sell any specific stock or index. And we'll look forward to seeing you again in about a week or so. Have a great day.